are from us. Okay, got it. The record. All right. So perhaps from, how is it? How is it? Okay, is it still there? The PowerPoint?
Yes,
there,
miss.
right?
It's
because
the PowerPoint.
it is not okay. It is not in the slideshow anymore. Oh, no, this one. Okay.
It's PowerPoint, but
Yep.
yeah, it's
Yeah,
full screen.
okay. All right. All right. So yeah, I believe that there are also students from outside the UMY, right? Yeah, I believe also that you have got these materials. Earnings management. It is so. It is something that is has the familiarity with you. And today I will put a focus a little bit on the ethical point. Yeah, ethical point of view. All right then. So there will be the review of the earnings management. And of course, because in earnings management, then the discussion will lead us to the measurement, right? Okay, the method and the techniques, all right? And also the motivation, right? Of the management that then engaged in performing earnings management in the organization. And then this is the something that I will share to you, some kind of behavioral or ethical issues, yeah, that underlies earnings management. Okay, I will put the result of surveys and also experimental research, yeah, at the end, yeah, that then will give insight for us. Yeah, I hope so. All right. So first of all, if we look at this, what is that? Cartoon, right? Cartoon. So you can read and you can watch this. I figure out a way, maybe it is a CEO and CFO of an organization. Yeah, we can imagine that they are the top management, right, of a certain organization. And maybe the CEO, okay, then talked, I figured out a way to double our quarterly profits. From now on, each quarter will last 6 months. So, okay, actually, it pointed out common practices that, of course, every organization want to achieve a good profitability, right? Okay, and this is actually okay. Many parties then, especially management, then try to produce more and more. Yeah, so this we can see that, okay, they want to double, yeah, the profit. Okay, I found out the way, but then the doubled one is not the profit then, because then each quarter will consist of 3 months actually, and it is that it will last 6 months. Okay, it is some kind of joke, but bitter joke about the common practice, yeah, in the organization. All right, and then concerning earnings management, the discussion then always leads to this questionable discourse. Earnings management, is it good or bad? It is ethical or it is unethical. So then management will less likely to engage in earnings management or more likely to engage in earnings management. All right, this is always be a big question mark. All right, so then maybe, we will answer this question later, right? Okay, but first of all, I would like to ask you first. It is not actually, it is not a quiz, or it is not something to do with the test, but I just want to know from the participants here. Okay, do you know what is earnings management? Anyone? Actually, then I try to prepare some kind of Kahoot, right? But then I have the difficulty in the signals. And okay, then I will ask you directly about this. Okay, anyone here? Okay, I believe that you know what is earnings management. So how many participants that know exactly about earnings management? Maybe you can raise your hand. I just want to count. Okay, if it is possible, I want to count. If you can raise your hand, then we can count how many. So no one raised it. No one. Okay, then how about the next? Earnings management is unethical or ethical in your opinion? It is not something that is right or wrong, not right or wrong question. I'm just trying to grab it from the participants. How about that? Again, okay, maybe then you are not sure. All right, then. How about the next? Which one that will reflect earnings management? If we face these two statements or two phrases here, intentional manipulation, and then the second one, discretion to achieve earnings goals. Okay, how about the participants here? I see that we have also international students, right, Mbak Kanita?
Yes, Miss.
Yeah, okay, we have. So there will be Abdurrahman.
Yes, and Habib.
Habib, and also from KKU. Is there any?
No. I think
not joining. Oh, okay.
This.
Okay then. Okay. So all right then. All right. So maybe you are not sure, right? The participants are not sure about this. And then which one of the value will be suitable with the other? About income increasing practice. It is unethical or not? Income decreasing. Okay, then I will skip this. We can then discuss it at the end if no one may propose their opinions here. Okay, then. So if we go to the definition first, okay, there will be a lot of definitions. Yeah, there are the variations of definition of earnings management, but basically then it is about judgment. Okay, the choice that can be chosen by management, right? In the process of reporting, yeah, financial reporting. Okay, but then there will be something the management do to alter the financial reports. Okay, to influence perception of stakeholders. Okay, and it will influence the outcomes, right? Okay, that depends on the report of the company members. And then we can also take a look at this one. This one will be more, okay, we'll move to, yeah, something that is more manipulating. Okay, right? Okay, manipulating. It's not only about the choice, about the judgment of the management, but then there's the intention then, yeah, the act intention of manipulation. Okay, if we discuss about definition, then of course we have to rely on the value reference, right? Okay, so here I won't read it one by one. You can got that after this, right? Okay, I take this from current papers in 2021. Okay, that have the review on earnings management, current earnings management, yeah, from Brennan 2021. So basically then, and also historically, there will be the terminology that has the relation with earnings management. The first one is about the accounting choice, right? Accounting choice, all right. And then income smoothing, also something that has the relationship here with earnings management. Okay, and the earnings management itself that then covers, yeah, for example, the words here will be purposeful intervention, right? Okay, and then something that can mislead the stakeholders, all right, and then yeah, something then what is that? Use managerial discretion, okay, discretion, okay, over the standards, right? All right, and then the last one, okay, then there will be the manipulation itself, right? Okay, that's the yeah, sort of definitions. So basically then, if we talk about the behavior of the management, yeah, in the context of earnings management, we can see there will be some kind of continuum. We can see that. Yeah, I collect the materials from some sources. Yeah, it is not from myself. Yeah, I collect the some sources. Yeah, references, and this will be one of them. So here we can see that there is some kind of continuum from the conservative point, right? Okay, so we know that we have the concept of conservatism, right? Okay, in accounting, and then okay, something natural, okay, in the middle, and there will be the move to go to the more aggressive action of the management. So here is the, we have to be careful with this one, the aggressive move, right? Because then here, that management still act within the standards requirement. Okay, we have the financial accounting standards, right? Right now we have diverse example, right? The international standard. And if management then move more to the more aggressive action, it can come to fraudulent accounting, because then there is the possibility to violate the standards. Okay, so if basically, all right, management want to looks good, right? Okay, in the financial report, yeah, because it is the reflection of their performance, of course, yeah, of the company-wide performance. So then there's the tendency to make it okay, more or more good than the actual condition. So there's the tendency to understate earnings, for example, or to overstate liabilities, and this will move and move to the tendency to overstate earnings and to understate liabilities. Correct. So the patterns, okay, earnings management. Basically, if we take a look at the phrase, then it is something to manage the earnings, right? To manage earnings. Okay, it can come from the income maximization. All right, of course, right? Or income minimization also. Extreme case, if you have heard the term taking a bath, okay, we can see in the next PowerPoint, right? Okay, so it can be income maximization. It can be also income minimization. Yeah, it depends on the interest, the need of the management. Okay, and then there will be also income smoothing, means that management tries to make the income from period to period becomes smooth. Yeah, stable, so it will look stable, consistent, right? Okay, something like that. All right, and if we come to the categories, so earnings management can be performed, yeah, from this two approach. Okay, approach. The first one is the most familiar one, yeah, the accruals based earnings management. So it will have something to do with the judgment of the management, the discretion. Okay, actually some choices of methods in accounting is something okay. Yeah, something okay with the standards, but then there will be also something that is not in line, yeah, in conformance with the requirement with the standards. Okay, so accruals based, because then we have the principles, yeah, aside from the cash basis, right? Then if we recognize the transaction, okay, it is not just as in the cash basis, the recognize the transaction at the time it performed, okay, not necessarily at the point that the cash you received, right? Okay, so then something can be managed there. Okay, something can be played, quote unquote, by the management. Okay, and then the second one will be the real earnings management, right? Real earnings management. This will have something to do with the operational of the company, right? Okay, the operational one, from the sales, from the capitalization, from the, yes, we can take a look at some examples, yeah, after this. All right, this is the example, right? Okay, from the accruals based earnings management, there will be some we can say techniques, or maybe the example right here. Okay, here about the timing. All right, manipulate the timing. It is about the recognition time, right? Okay, recognition time. So for example, then management recognize the revenue before goods are shipped, or aside from that, also may defer the expense. Yeah, okay, this is commonly performed, right, by the management. It is about the timing of the revenue or expenses recognition, with the objective to boost income, of course. Yeah, okay, and then the second one can be from the, all right, capitalization. Okay, some expense, right? If, for example, related to project, something something to do with the long run operation, okay, then can be capitalized, okay, but some of the expense then have to be still expense, okay, but then management may again play something there, okay, and then capitalize something that has to be actually expense, right? Okay, and then here number 3, right? Cookie jar reserves. Okay, cookie jar reserves. It can be the analogy will be, right? Okay, if we have cookie jar, you know, cookie jar, right? Cookies, you have, for example, favorite cookies, okay, maybe at Lebaran time, all right, or maybe you have your special your favorite chocolate or candies, right, and you put that in your jar, okay, and you keep it until the right time, okay. You really like it and you want to consume that at the right time, so that you will have the opportunity to have the benefit for that, okay. So here, for example, that management diverse something, all right, or keep something, maintain, reserve something, yeah, in this case, then they over accrue, for example, the allowance for a debt in a good year, okay, for the sake of the next or the future periods, okay, for the next period's benefit, right? Okay, so this is also to boost the income, right? Okay, and then the next one actually is just the same, yeah, big buff phenomenon, yeah. we can, but we cannot translate it directly to mandi besar, to fenomena mandi besar. It is something, something that actually to do with achieving something in the next period. Okay, higher earnings in the next period, subsequent periods. So for example, that it is performed, for example, by the top management or CEO, new CEO for the next period, for example, that someone is pointed out as the CEO for the next period, and then in the current, in the current period, then there's the action, there is the action to make the condition is not really good. So then in the next, in the future, at the time that he is in the pointed position, it will look good, right? So it will shows that all right, the performance is good after they are in that position, because phenomenon. So actually, because maybe there's then the flood of earnings in the futures. Okay, so something that is preserving for the future, and then of course, then there will be an interpretation of accounting standard more aggressively. This is the aggressive action, right, of the management. Okay, and then also the decision to adopt new standards that will have something to do with the earnings, will affect the earnings. Okay, and this one is discretion again. It is about the choice, right? Okay, about the choice to achieve higher earnings in that period. For example, the choice of the method and the depreciation, the salvage value, useful life, right? Okay, so it is about the choice, and then the last, classify items based on the earnings effects. So everything to do with something affecting earnings, okay, then will be executed by management techniques, right? Okay, and how about real earnings management? So if accrual-based, then will have something to do with the recognition, with the recording, with the record in financial report, then this one, of course, also have the objective to boost the earnings, but through a real operational action. For example, this one, to boost the year-end sales, right? Then management then try to incentivize customers to purchase more, at the year-end, right? Okay, cutting prices, discount, offering some programs, so customer will buy more, at the end. Okay, and then this one will be something to do with asset. Okay, so the decision whether to purchase or to sell assets, then I have to consider this one. Okay, how about the depreciation? Okay, management try to avoid additional depreciation cost. Okay, so then they will avoid that, okay, or defer that, okay, and so on. And then also, for example, in something to do with the hiring employees, okay, because then if they hire directly at that period, then they will have some expenses, at the consequences at that current period. So okay, then they will delay that, okay. And then the next is also the same, reducing or postponing R&D activities, or advertising expenses, or something to do with discretionary salary, administrative costs, yeah, administrative expenses, yeah, okay, something to do with that. And then the last one, increase production, yeah. Why that? Okay, why then? When the management decide this, they try to have excess inventory and then reduce cost of goods sold by spreading fixed cost. Because if they increase production, the numbers, the stock keeping unit, the number will increase also. Then it means that fixed cost will be spread over a large number of units. Thus, it will reduce cost of per unit, of course, right? Okay. All right, and this one. Okay. All right. So what then? Okay, why management has the effort to do this, to do that, right? Okay. To divert something, to delay, okay, and some efforts that is not simple, right? Okay, actually they will have some of these motivations, yeah, with internal target, external expectation, something to do with income smoothing or window dressing. Okay, the first one here, internal target. Well, this is something, yeah, we can know exactly, all right? Everybody wants to achieve more, yeah? Every organization wants to achieve a good profitability, of course, and by doing what is that? By doing or by performing their best efforts, yeah, they hope, they expect that they can make a higher profitability, right? Okay, so sometimes then there will be a tools for motivating every parties in the organization. Okay, some kind of bonus plan, right? Okay, and also something to do with this one, targets, right? Earnings targets. So internally, this is important tool, right? In motivating the managers, especially, yeah, to increase sales, yeah, to control cost, yeah, use the resources efficiently. Okay, all of this then will come to the end in boosting the earnings, right? Okay, but unfortunately, then this may leads to something not right. Yeah, okay, so in trying to meet internal target, management then has the tendency to do everything, including earnings management, right? Okay, all right. And then external expectation. It's not only from the investors, right? Okay, external will be investors, the government, and so on. It is also from employees, customers, yeah, suppliers, yes, all of the stakeholders will be the external parties, right? That have the expectation to the organization, yeah. Customer want the company to do well, of course, survive in the long run. Suppliers also, they have the interest to receive payment from the company, right? Okay, so they also expect the company have the good performance, right? Okay, and this again leads to the practice of earnings management to look good for everyone, right? Okay, and this is the third one, the motivation, provide income smoothing. So we can compare, for example, this one, right? We can compare company A and company B. So the the first one, okay, have the red trends here, okay, yeah, in income, in annual earnings, and company B has the fluctuated what annual earnings. So the organizations need to look good also from the from the consistency, from the stability, right? Okay, if it is not stable, then the related parties, of course, will have, will have something not to trust the performance of the organization. So there will also the effort to make income smoothing here. All right, and then the window dressing. All right. So then sometimes, organization is at the critical period, very important time, right? Very important time that they try to look good, right? The performance, because then they have the interest, for example, to have the loan, so applying for a loan, for example, or just before the initial public offering of stock, right? Okay, so it is very important for them, for the organization to look good, of course, especially the reported earnings side, right? Okay, because that will be the basis for the decision whether they will get the loan or they will get investment, for example, right? Okay. So that's the motivation, right? Okay. But then, okay, every parties have then the interest, to know, is the organization, is the management actually performing an earnings management or not? Okay, so then we come to this discussion, because actually it is impossible to detect every accounting choice made by the management, right? Okay, and whether that choice is made for the opportunistic reasons. Okay, something opportunistic, something is not really right. Yeah, okay, so there have been some research. That explore the measurements here. Okay, the way, okay, to detect, the way to know exactly, maybe not exactly, but from the proxy, right? Okay, whether there exists earnings management or not. Okay, so then since then earnings is composed of two components: from cash flow, it is from the operation, and from accruals, right? Okay, so then we can see that operating cash flows are very difficult to exercise discretion over. So then researcher that try to explore that typically focus on the accruals, the levels of total accruals by firms. Then, okay, accruals, typically used by firms to recognize the consequences of transactions in the periods, right? Okay, in which they occur. And these accruals, it is for judgment, right? Commonly involve the thing, discretion. Okay, so here then means that accruals is more susceptible to manipulation because there's the discretion component. Okay. All right, so I won't have a deep discussion on this because I believe that you have got some discussion in your courses, in financial accounting, that there will be many models. Okay, we have the so familiar model from Jones, right? Okay, it is about how to detect the level of abnormal accruals, right? Okay, the discretionary accruals, the abnormal one. Okay, you can see from the work from Healy, D'Angelo, Jones, again, Cho, Ekaari, and so on. Okay, all right. So the measurement then, basically, mostly rely on discretionary accruals, right? Okay, this is the model. All right, it is the model of calculating total accruals. All right, there will be in the model there will be the change in current asset and cash and current liability, short-term debt, Income taxes payable, all right, depreciation, okay, total asset. And then there will be the step to estimate the coefficient, yeah, of normal accruals, okay. And then because these are related to changes in revenue, and also by the level of plant, property, and equipment, PPE, all right. And then the coefficient from that previous model then apply to the event years in predicting normal accruals. Then finally, the abnormal accruals is can be obtained as the difference between total, yeah, from model 2 and the model 3. Okay, so then the abnormal accruals is the proxy of the earnings management. Okay, yeah, this is from Jones, yeah, popular one. But it is not only from Jones. There will be the revised, adjusted Jones model. There will be some approaches from another researchers, yeah, and also standard setters also have the interest in specific accruals that used in earnings management, depreciation estimates, better provisions, deferred tax valuations, so on. Okay, all right, and all right, this is the important thing, right? That since then earnings management is okay, something to do with the action from the management for presenting the numbers in, especially the numbers of earnings, right? In the financial report, that is not really reflected what happened in that period, then it will leads to the quality. Okay, the quality of the earnings itself when there's the earning managements, right? Okay, that is that one, right? Okay, then it will also leads to financial reporting quality. Yeah, okay, because then the numbers there, the numbers in the report, that is the basis for making the decision by a lot of parties, a lot of stakeholders, right? Then it's not something that is reliable anymore, right? Okay. And in the research also, some variables, another variables is tested, yeah, from the governance, good corporate governance proxies, audit quality proxies, right? So for this one, okay, and currently we have also ESG, right? The environmental variables, yeah, social variables, and so on. All right, that's the earnings management, right? Okay, and here is something interesting, yeah, because then we will take a look, yeah, we will take a look at more behavioral aspect, yeah, of that action, yeah. We consider that earnings management is an action. All right, okay, so this is from IMA in 2018, but I think it's still relevant for us today. Yeah, so IMA have this survey for around 122 financial reporting managers in the US. Okay, what is the point that they survey? Okay, so they asking questions for those managers, right? The managers that has the direct relationship with financial reporting, of course, right? Okay, so it is about the earnings management decision. Okay, so especially in increasing earnings or decreasing earnings. All right, so first, yeah, the first question, then when, here we can see here, when no one is watching, right? So in the context that there is no oversight, okay, from, yeah, regulatory bodies or from specific bodies, yeah, to do the watching, right? Okay, action. Then what is the perception of the managers then? They will okay, they will increase earnings or not. Yeah, actually, yeah, this is the actual action that they perform in their each organization, each companies. So here, figure 1 is the result of this survey that 90% of the managers, okay, will increase earnings. Okay, actually increase earnings. This is earnings management decision when missing analyst forecast. So there's the terminology of beating and missing, yeah, the analyst forecast. When it is missing analyst forecast, that means the actual reported earnings is equal with the forecast from the analyst, right? Okay, so here, when it is not publicized, no one will oversight. Okay, so managers will increase earnings. Okay, and then how about the next? All right, so it is when beating analyst forecast means that the reported earnings is above, yeah, above the forecast of the analyst. All right, then still the majority, yeah, 64% will increase earnings. All right, and then okay, how about their perception about the ethicality of earnings management, of the action to increase income? Yeah, and it is interesting that actually they aware, yeah, they aware that what they perform is more unethical. So it is not something that they are not understand or not aware, but they are aware that it is something unethical, and they still perform that because no one is watching. All right, all right. This is something. Oh, okay then. All right, yeah. This is the result of the survey. Maybe we have to do the same survey also here, right? Okay, to see the result. All right, so still most of or majority of the respondents, yeah, perform that income increase from perform income increasing and aware that it is more unethical. All right, that is the context when, yeah, there is no oversight from another parties. Okay, yeah, so here the next of the survey is when the public is watching. Here, there's oversight budget. Okay. Here, when the public is watching and when the condition is in the missing analyst forecast. Okay, so it means that their action will be publicized. Yeah, will be publicized there on the context of that survey. There will be a watch list, right? There will be included. They will be included in a watch list. And what happened? Okay, still they increased earnings. All right, but yeah, it is decreasing. Yeah, the proportion, the percentage of the managers that perform the increased earnings is decreasing here, 47%. Yeah, compared to what is that? 64%, right? Okay, it's 90, 64, and then here 47%. Okay, and when it is beating analyst forecast, okay, the proportion reduced more, okay, to 24%. All right, and how about their perception of the unethicality? Oh, okay, yeah. Unethicality, yeah, that we can see that where is the ethicality here? Unethical. Here, yeah, more unethical if they perform income increasing, right? Okay, so the surveyor, the IMA, then move further, right? Move further to observe, yeah, to observe their opinions, right? About actually what is the consequences that they perceive of being watched. right? Because then there will be the reduction, right, in the action, yeah, in their perform, yeah. Okay, so here is the result that the managers, yeah, financial reporting managers that is included in the respondents, yeah, in this survey, then stated, okay, this, okay, consequences that they aware there will be negative consequences, yeah, if they perform some, yeah, aggressive move, right, yeah, or some action to increase the earnings, right, income, yeah, okay. So the first one, okay, they perceive that, they're aware that it will damage company reputation, of course, right? Okay, yeah, damage company reputation, and then also, okay, there will be effect on shareholder perception, yeah, shareholder perception, and the effect will be, of course, will be significant because it is something to do with the shareholders, right? Okay, and then loss of trust, yeah, of course, also trust will decrease when then the company then being included in the list of the company that has aggressive move, right? Okay, to perform earnings management. And then also, yeah, consequences of negative stock market reaction, okay, damage to customer perception, supplier perception, yeah, the relationship, the good relationship with the company, okay. And of course here, yeah, there will be increased or stronger, yes, stronger oversight than, yeah, from the regulator, from the auditor, yeah, okay. They will have to be careful then with that. And also, yeah, the last, there will be possibility also from the employee perception of this move, right? Okay. All right, that's interesting because they are aware, and we can have this analogy with ourselves, for example, in our daily activities. When if you remember, if we are in our vehicle, yeah, you driving your motorcycle maybe, or you drive your car and you go to the intersection, okay, the red light is there, but then, okay, you feel that no police over there, and no police in the surroundings, and you just go the red light, yeah, past the red light. It is frequently happened, yeah, it frequently happened, okay, to us, yeah, because it's the feeling of we are not being watched, okay, by the policeman. Okay, that's wrong, right? Okay, that's wrong because it is not from our awareness to go and to obey the regulations, right? But right now there is a CCTV, right? Okay, you can got the what is that? Okay, the love letter from the authorities, yeah, because you got okay, automatically, yeah, catched, yeah, to pass the red light, for example. Yeah, it is something that being watched and not being watched is something has the effect for us. Yeah, it is something that is related to our behavior, right? Okay. Yeah. All right, that's the first one. And we move to another proof also. Yeah, a confirmation from a research result. This one is an experiment. Okay, the previous discussion is about survey, right, from IMA. This is about an experiment. If in the survey, IMA got the perception from the managers. Okay, here the researcher, It is here in Indonesia and in Jogja, right? Okay, it is published in the journal from UMY, from the accounting department, JAI, the Journal of Accounting and Investment in 2020. Okay, it is about ethical orientation, because then the discussion of risk management, right, that will have something to deal with ethical consideration, right? Ethical consideration. So, is there actually something that can mitigate that? Something like that. So, how about ethical orientation? Here, the researcher has the question of that matters, right? Is ethical orientation that then matters in what? In mitigating the earnings management action. All right. So they have the test on that thing. Okay. The test then executed in experiments. So not like the survey that then spreading the questionnaire. Here in the experiment, the researcher have the treatment to the participants of the research. So here there will be participants in the research, and they will have the treatment from the researcher. So the background here then actually the discussion that earnings management is something that is from management intervention, right? Management intervention towards the financial statement. It is about accounting policy choices, right? Okay, which one is permitted, which one is not, right? Okay, under the standards. And this earnings management action, okay, if it is not right, okay, then it can reduce the credibility of financial statement. Okay, this from Sekar 1989, right? Okay, this is why then earnings management has something to do with the quality of the financial reporting, right? Okay, because then the credibility can be reduced, and then the next, it will mislead and deceive, right? This not only shareholders, actually stakeholders, right? Okay, it can the financial report itself that contain not qualified earnings, yeah, the number there, okay, then will mislead and deceive, yeah, the parties that have the decision based on the financial report, right? Okay, all right, so then with that argument, okay, earnings management actions then can be judged as unethical, yeah, unethical, okay, and may result in profit manipulation, right? Okay, this one, manipulation, all right, and then previous studies, previous research in the literature also have confirmed that the tendency of this manager, yeah, the management of the organization, yeah, to manage earnings, yeah, to perform the earnings management, that comes from some internal motivation. This is really behavioral aspect, yeah, internal motivation, yeah, internal motivation. Several factors will affect, yeah, many factors, and researchers has tried to explore that, yeah, one by one, yeah? Okay, in the previous research, one of and then since it is something to do with the ethical aspect, then one from Greenfield et al. 2008 and also just 2013 explore this one, ethical orientation. Okay, but then is ethical orientation then matters? Is it really can reduce? All right, okay, can reduce. Is the ethical orientation of the individuals, the management, is good? Yeah, the point is that then will the earnings management tendency will decrease? Okay, that's the question. And researcher here, after STV et al, try to test this in an experiment, right? In an experiment. Okay, and okay, this is the explanation, right? Okay, that they test the ethical orientation effect, yeah, whether it can mitigate the tendency, yeah, of this opportunistic earnings management decision, okay, at a specific condition in an asymmetry information condition, and also in specific management status. Because then previous research also leads to this confirmed result that when there's a symmetry of information, okay, you remember symmetry of information, that management has the what is that, access of those details information, yeah, management here, and for example, the shareholders, yeah, the owners of the company cannot get the details information, then there will be some symmetry of information, and this will open, yeah, the opportunity of something not good, yeah, including earnings management, right? Okay, and they based their research on procedural behavior theory to explain, yeah. Okay, there has to be a theory to explain that, yeah. So here, managers' ethical orientation is proposed to have what is that effect, because it will control the behavior. It will control the behavior of the management in managing earnings, yeah, which is caused by asymmetry of information and by their specific manager status. Yeah, there will be in the orientation. Yeah, in the orientation there will be relativistic and idealistic. And with the idealistic orientation and the ethical orientation concept, then managers will tend to avoid making earnings management rather than the relativistic ones. And where we can find this ethical orientation, it is measured. Yeah, there's the measurements, yeah, the ethical measurements, right, from the instruments, okay, specific instruments that then can be performed to the participants, and they can be categorized in idealistic or relativistic ones. All right, and how about then the result of the experiment? So when the researcher then executed the experiment, they put the treatment to the participants here will have to take the information, okay, take the information about specific organization, and they will have to decide at the end. They will have to decide whether they delay the recognition, okay, the recognition of maintenance cost or not. Okay, so that will be, yeah, so this is the earnings management from the timing, right? Timing of the recognition. So there will be, yeah, there will be the decision, yeah, that will then in this research will be affected by, okay, the asymmetry of information, by the management status, and also at the specific ethical orientation of the individuals. Okay, and the result, okay, the result is here. So then it is matter, yeah, ethical orientation does matter, yeah, because then earnings management in this specific context influenced by the ethical orientation of managers, and depending on the condition of asymmetry information. When there is high asymmetry information, so earnings management behavior will exist, and it is higher for the relativistic orientation manager. Okay, whether in low asymmetry, okay, average earning management is higher for idealistic manager, and ethical orientation affects more on high. Yeah, it means that ethical orientation affects more on high asymmetry condition, right? Okay. Well, that's the all right. The example of a research result, yeah, concerning earnings management axiom, right? Okay. So back again, we come in. All right, in the description of this cartoon. Okay, this is maybe also the CEO or CFO of the organization, right? So we are in good shape. Nobody understands our financial statement. So this reflects that when nobody is watching, yeah, there is no oversight, no, what is that? No independent body that has the in the position, yeah, to watch, then okay, the tendency of the manager will be like this, right? So that we will come to this one, ethical orientation of the management of the organization. Yeah, something like that. Yeah, the point is something like that, right? Okay. So, okay, we have come to concluding points here. Okay, since it is already 4 p.m. here. So from the survey, right? Okay, from the survey, the IMA found that managers are more willing to engage in income increasing earnings management when they believe they can do so without being observed. Okay, when nobody is watching. And then, okay, it appears that decision to engage, yeah, the intention, yeah, to perform earnings management actually involves trade-off. Yeah, there's the incentive to meet earnings expectation. Okay, and at the other point, there will be also incentive to avoid appearing overly aggressive. So when there's the possibility that there will be the body, the standard body, what is that? The watching body, yeah, that will expose, yeah, their aggressive action. Then actually, the what is that? The intention to engage in aggressively risk management will decrease, right? Okay. All right, this finding suggests that risk management behavior largely contingent on the extent to which the public is able to detect, to oversight, yeah, such behavior. Yeah, maybe it's through the use of investment tools, company watch list, yeah, okay, the oversight body, yeah, and other means. Okay, all right, so the more observable, right, the less likely managers to engage in potentially fraudulent financial reporting. Okay, that's the end. All right, yeah, I think that's all, Mbak Kanita. I will give the time back to the master of ceremony. All right, thank you.
All right, thank you so much, Miss Dyah, for the attractive material. Hopefully, it can help the audience to have a better understanding of earnings management and quality reporting. Okay, continue to the next session is Q&A session. Please, to all of you guys who has question, please raise hand and turn on your camera.
I hope the audience don't get bored with this. This is our last sessions. Okay. or maybe already exhausted. Yeah. Mhm. All right. It seems everything is clear, maybe, Mbak Kanita.
Yes, Miss.
Mhm.
I think it's okay if we continue to the next agenda, Miss.
All right. Mhm.
All right, Miss. Continue to the next agenda, which is photo session. Please, all of you guys, turn on your camera.
Hello. Where's everybody? Oh, yeah, I see Abdul Rahman. Hello.
Yes, Miss Dyah, how are you?
Yeah, great. Okay. Mm.
All right, are you ready, guys? I count 1, 2, 3. Once more, 1, 2, 3. All right, continue to the next agenda, which is closing. As the master of ceremony, I do apologize for any mistakes during this event. Thank you very much for joining the class and see you at the next event. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh.
Terima kasih banyak, Bu Dyah.
All right, most welcome to you all.
Thank you, Miss
Okay.
Dyah.
Yeah, thank you, everybody. Okay, I hope we can see in another occasions, right? Okay, we can meet on another future events, right? Okay. Okay, then I will leave. Yeah. Mhm. Yeah, thank you, Mbak. Thank you also for all of the committees from IPAC. Yeah, goodbye.